these are the slides that you have in your in UTS Online. So we are going to have a quick look at the methodologies. After every methodology, we are going to see 3 of them. Okay, the 2 that AQR uses, plus an additional one that many other banks use. After each methodology, we are going to stop and do an exercise where we apply it to the US stock market. Okay, so that's just the way we're going to do it. If we don't have time, if we don't finish, there is no panic, because next lecture will still be on this topic, just on MATLAB. And so we will take a few minutes at the beginning of the next lecture to finish if we run out of time to cover the slides. Please also remind me that when we are around 2:40, that I need like 5 to 10 minutes to talk about the group assignment. So if I forget around 2:40, 2:45, please stop me. Okay. So forecasting long-term returns. Now, the general idea is that whenever you talk to people about, hey, how do we forecast long-term returns? 90% of the time, people simply take, why don't you just look at the historical return? Okay, so that's what traditional people do. That's especially because when Markowitz wrote his seminal paper on the portfolio optimization and the efficient frontier, that's what is used. Now, the Markowitz model is not exactly strong in that department. Markowitz said, okay, let's assume that expected returns are this. I'm going to show you how to build the portfolio, the efficient portfolios, given the expected returns. Okay, in theory, you can do Markowitz with any kind of expected returns. But Markowitz used the historical average. And so lots of people used to do historical average. Now, historical average is really bad. Because historical average basically is based on the idea that the past can tell you something about the future, and specifically that the average return is constant in time. People say, look, I know that returns fluctuate. Some years the stock market gets a higher return, some years gets a lower return, but on average, over, let's say, 10 years, the average return is constant. So if I take the average long-term return from the 70s, the 60s, the 80s, is the same as today and is the same as the next 10 to 20 years. Okay. Now, we know that this is not true because there are fundamental forces in the economy that change and creates what we technically call structural break. So the structure of the economy fundamentally changes. And so the long-term average performance of the stock market in the 80s or the 70s doesn't tell me much about what's going to happen in the next 10 years. And this is an example. This is the clearest example of structural break that you can imagine is inflation. Inflation used to be pretty high after the war. Then there was a period of very low inflation in the 50s and the 60s. Then there were the oil crises of the 70s and the 80s with very high inflation. And then under Paul Volcker, the Federal Reserve changed the strategy to deal with inflation. And since then, inflation is relatively stable and low. It fluctuates, but it fluctuates more or less around 2%. Sometimes it goes negative. That's a weird thing that should be avoided, but it happens, but is relatively mild. Okay. Now, it's basically impossible to think that looking at the stock market in this period, let's say between the 60s and the 80s, can tell you anything about today because the structure of the economy is fundamentally different. Inflation is different. The Federal Reserve reacts to inflation in a different way, etc. So it's a different game. So it's really difficult to take data from that period and use it to forecast. Okay, at least it's not always successful. And one may say, well, look, but if the problem is just inflation, we could do what AQR does or other banks do. They try to forecast the real return. And the real return, we know, is the performance of the market taking away the inflation. You say, look, if the only problem is that the inflation goes up and down, well, we can forget about the inflation and we can try to forecast the real return of the stock market, that is the return taking away the inflation. But the inflation is not the only non-stationary element. even more striking is what you see here. This is the real return of a long-term bond. Okay, it's the real long-term returns of bonds. Okay, government bonds. Okay. Now, this is after inflation, taking away the inflation. So the inflation doesn't affect this picture in any way. And what we see is that there is a very long-term trend of decreasing interest rates. Real interest rates in the 80s in the US were around 8%, but then started coming down to the point that today they dither around 0. Okay, so this means that the price of time has changed, or the availability of cash has changed. So today, investing in the risk-free asset gives you basically 0. Here, it used to give you 8% after inflation. Okay, so it's impossible to think then even expected real returns from the 80s and the 90s can tell you anything about today, when the cost of money is so low. Okay, because something has changed fundamentally in the economy, and this long-term trend in the risk-free rate affects everything else. Okay. Okay. Any question up to this point? So the general idea is a big temptation to forecast long-term future returns by looking at historical returns. Problem is, doesn't work very well. Okay, it may work sometime, but there is a big risk if there is a fundamental shift in the structure of the economy, the policies of the central bank, and all this type of stuff, that history is not a good predictor. Now, what companies tend to do is basically to look at firm profitability. And the idea is, there is a certain evidence that has been accumulated in the last 30 years of academic and industry research that firm profitability can, to a certain extent, predict market return, and that's to be expected. If a firm becomes more profitable, the stock market price will go up faster. No? So firm profitability is correlated with future market return. That's what you would expect in a normally working market. Now, all these models that we have to forecast stock returns, they work even better if, instead of looking at an individual stock, we look at the stock market in general. Because it's easier to apply models to the stock market in general rather than individual companies, because individual companies, a lot of stuff can change idiosyncratically. The CEO changes, the business model changes, the company becomes smaller, larger, that changes the structure of the company. But when you look at the stock market in general, so you look at a portfolio with 6,000, 5,000, 2,000 stocks, depends on the country, it becomes easier to look at the link between the profitability of all the companies together and the return of the stock market together. Okay, now these are by no means perfect. So as you will see, the end point of next week's lecture will be to take all these methodologies, look at how accurate they are, and we are going to see that they are not very accurate, and we're going to get very depressed. But then we're going to see that they are much more accurate than simply using historical returns. Okay, so this is going to be our journey. Okay, so this is a bit of introduction to say we cannot use historical return, or we could, but we don't want to use historical returns because most banks have moved away from that. As a note of reference, I entered into this topic because a few years ago, like 12, 15 years ago, former PhD students of mine that worked for a bank in London asked me to participate to an industry research that they were doing, where they wanted to look at these methodologies and compare them to the historical return that most banks at the time were still using. And we showed that these methodologies are much more accurate than historical return. In the last 10 years, many banks have moved away from historical return. So all the banks that I showed you at the beginning, all the investment companies, nobody uses historical return anymore. Okay, so let's start from the simplest methodology, the dividend discount model. You already know it, but you will see that the payout model of AQR is basically this. Okay, So you know this methodology. You have seen the dividend discount model in the context of forecasting the correct price of a stock. And the dividend discount model basically means exactly what it says in the name. It says, look, the price of a company is the present value of all the dividend that this company will pay in the future. Okay, and this is not controversial at all. So look, you take all the future dividend payments, you do the present value, that's the price of the stock. Now, we also know that the dividend discount model in this initial formulation is a bit unrealistic because it forces us to forecast the dividend in time t for every year in the future. And nobody knows what dividend Microsoft is going to pay in 10 years, in 15 years, in 20 years. We don't know, okay? Nobody knows. So when I think it was Gordon who invented these methodologies in the 40s and 50s, what they say, okay, let's make a simplifying assumption. Let's assume that dividends will grow at a constant growth rate, okay, that we call G. And so we're going to say, hey, look, I don't know what the dividend in time t will be, but I assume that it's going to be the dividend today applying a constant growth rate G every year. So basically, dividends will go up as a straight line at a constant rate G. Okay? Any question until this point? We should already have seen this. Okay, so we also know this is a sum of an infinite number of terms. That is a bit annoying, but we know, because we've seen it, this is the thing that you see whenever you do the dividend discount model, that if you assume that the growth rate is lower than the discount factor, then that sum of infinite numbers converges to this result. The price of the company is equal to the dividend today times 1 plus G divided by R minus G. Okay, so that is your dividend discount model. Okay, now, normally, this is what you have seen in your finance subjects, where basically you were looking for the correct price of the stock. Now, the way we use this method, the way this methodology is used today is slightly different. And the idea is, we don't care about what should be the price of the stock today or the price of the market today. We assume that we know that. We assume that the market is correctly priced. What we want is the expected rate of return. So we're going to take this formula and we are going to solve it for R. We are going to solve for the expected rate of return, R. Okay? So you take the formula and you solve it for R, and you get this formula here, where basically it tells you R is equal to D0 times 1 plus G divided by P0 plus G. Okay? Now, in this type of calculations, people tend to be very approximate, they approximate a lot. So this thing sometimes gets taken away, and what you're left off is this. This says the expected return is the dividend yield today plus the growth rate of dividends. Okay? And if you go back to the AQR paper, this is exactly what they have, with the only complication that they say, look, this methodology was developed in the 50s where companies used to pay a lot of dividends. Today, you have a lot of companies that don't pay dividends. And so it's better to substitute the concept of dividend with the concept of total payout. And total payout is basically dividends plus stock buyback at the market level. You see how many dividends have been paid, how many millions of dollars have been paid through stock buyback. I think that some companies do dividends plus stock buyback minus new stock issued. That's anyway. So that's just a technicality. Okay, the idea is dividend yield plus growth rate of dividend. Sorry, just a bit of this thing here is terminology that I use in the teaching note. I realize that not many banks use it, so I'm just going to clarify it. This Greek letter is called mu, and for some reason in finance is considered as the letter for expected return. So mu DDM means expected return according to the DDM methodology. So the expected return according to the DDM methodology is dividend to price plus growth rate of dividend. Okay, so mathematically makes a lot of sense, is incredibly easy, and it just comes from, you know, simple bit of algebra starting from the very basic dividend discount model. Okay. Okay. So dividend yield plus growth rate of dividend. Now the dividend yield is very easy to find because it's public. This is the dividend today divided by the price today. So we can see it anywhere. You know, you just open a newspaper and you have the dividend yield there. Okay, so that's not a problem. The problem is that G is, in theory, is the expected growth rate of dividend. Okay, so G is the growth rate of dividend over the next 10 years. If we are forecasting, you know, long-term equity returns, normally you've seen many banks that they consider a 10-year future return. So you need to know how much dividends will grow over the next 10 years. Now, nobody knows that because nobody has a crystal ball, you know, unless you have a time machine. So what people do normally is to look at the historical growth rate of dividends. And here, we are going to, you know, a little bit put our foot in our mouth because we just said at the beginning, hey, look, we shouldn't really look at historical stuff because history changes. Well, we still do, but instead of looking at returns, we look at the historical profitability growth of companies as a whole. And roughly that tends to stay stable, okay? So as you can see here, there are the historical dividends for US companies between 1950 and 2020, 2019, I think I did this graph. So there is a growth rate. Now, please don't be, you need to learn to read graphs. So this is a logarithmic scale, okay? And as all the logarithmic scales is a bit cheating, because, for example, even a small variation from the trend can actually mean, when you look at the actual number, big fluctuations. So we're going to see later in the simulation that this is actually more complicated than it seems. In fact, AQR does a bit of a cheat here, but we're going to see it later. Just one thing. Historically, I prepared the slides on the teaching note, and I prepared the teaching note, I think now 4 or 5 years ago. In the meantime, I've changed my mind because the data has led me to go elsewhere. So actually, I would no longer recommend to use 10, 20 years. We're going to see later that it's better to use a longer period. Okay, so please just keep that in mind, that using 10 years of historical dividends to forecast a 10-year of future dividend is a bit risky, and I'm going to show you later on why. Okay, when we look at the numbers. Okay, now we spoke a lot about inflation, and you may remember that AQR, they forecast real returns, not nominal returns. So they tend to forecast returns without inflations, okay? And that's exactly what we're going to do here. So what we're going to do here is basically to look at real returns, real dividends. So the idea is we're going to estimate the growth rate of real dividends. And this will give us the expected return in real terms. Now, funnily enough, the dividend yield doesn't change with inflation because it's a ratio between two numbers. So even if you take the ratio with or without inflation, being a ratio of two numbers doesn't change, okay? But if we measure the growth of the historical growth of real dividends, that will give us the expected return in real terms, okay? Then, if from this we want to derive the expected return in nominal terms, we just have to add expected inflation. And that's exactly what AQR does. Okay, AQR, you have seen in the table, what they do is to do the calculations, and then they add 2.1% because that's the expected inflation that they have on the for the next 10 years. Now, can anybody in chat tells me if they have an intuition of why we are doing this mess with inflation? Why are we taking away the inflation from here? So we calculated the growth rate of dividends without inflation, and then we add the inflation back here. Can you tell me why are we going through all this pain? Why taking away inflation from the historical data and then we add the inflation again at the end? Tak, yes, you are correct. We want to get the real return, but then why do we add the inflation back to get the nominal return? So why, apparently, we could get directly to mu by simply not bothering about the inflation. Okay? Not exactly. Anybody else? Because we are doing a double passage. We are taking away inflation from dividends. Okay, Julian says we want to separate historical inflation and historical returns. Why? Why, if then we are going to add back the expected inflation? You are almost there, but think a little bit. Why do we want to take away the historical inflation if then we are going to add back the expected inflation? Julian, that's correct. So the idea is that we don't want to assume that historical inflation is going to be the same as the future inflation. So we may apply this methodology after, let's say, 20 years of very high inflation, but we have the expectation that the inflation in the future will be low. So we need to create a forecast that is purified from the historical inflation because we think that inflation will not carry forward. And so we may have, we want to take away the historical inflation because we don't know if that's going to continue. We do the expected return, and then we add what we think is going to be the inflation in the future. Okay, that's exactly the point. Okay, does it work? This graph, you will notice, is slightly different from the one that you have on the slides. I did a bit of a change this morning. I just wanted to clean up the graphs. I didn't put them online yet. Basically, I'm just adding the last few months, so it's not really a big problem. So don't worry, this is just like to give you a little bit of an intuition. So does this methodology work? Well, it used to work relatively well. If you look here, the 50s and the 60s, the red line is our forecast, and the blue line is the return of the market in the following 10 years. Okay, so the first number that you have here, this is my forecast in January 1950, and this is the return of the stock market between 1950 and 1960. Okay, so we are kind of there. Okay, we are underestimating a little bit the market in the 50s and 60s, but we are pretty close. Okay, then, as you will notice, from 1965, the methodology kind of dies a little bit in the sense that it keeps forecasting returns around 5% when in reality the stock market is tumbling. But these were very extraordinary times because you had the oil crisis. Anyway, from that point on, the methodology doesn't seem to work very well. Some people say, well, that's because companies stopped paying dividends, so it's not really that very relevant now. And of course, this methodology failed miserably when there is an extreme market return. So let's look at here. The return of the stock market between 1999 and 2009 was negative 5%. That's when the tech bubble exploded. The tech bubble exploded at the end of 99, at the beginning of 2000. And the return in the following 10 years was was basically negative. The market lost 5%. Now, this methodology was telling us, hey, look, returns are going to be low, around 2.5%, but not negative. So this methodology didn't guess the negative return between 99 and 2009. So when there is an extreme market movement, this methodology fails. Okay, we're going to see how we can fix this later. But basically, yes, there is a little bit of predictability, but it used to be much better in the 50s and 60s. Dividends are less relevant, so the methodology doesn't work very well, at least in this form. Maybe if you add buyback that we don't do because we don't have the data, maybe it would work better, but in this form, it works, a little bit, but not that much. Okay, so any question on the methodology? If we don't have questions, we can go to Excel. So I posted online. You have two files in UTS Online. You have the file data returns 2020. Sorry, I didn't share my screen. So you have data returns 2020. And then I also posted the solved version. Normally, I would post the solved version after the lecture, but I realized that with Zoom, it's difficult for you to move between my screen and your own screen, so typing with me. So I'm going to use both files. Some formulas we're going to type, some formulas we're going to use this solution and just look at how the formula works. Okay. So let's start from the empty file. So this is the file that this is an Excel file that I give you just with some data, so we can work a little bit on it. So what you have here is data from the US market from 1900 to the end of 2019. Okay? Okay. So what you have is the S&P 500 index. This is the index. Then you have the earning per share, basically how much earnings is paid for every point of the index. Now, remember that the index is a portfolio of shares. It's not exactly one share for every company, but it's a portfolio of shares, okay? So the price of the index, you can imagine, is the price of this portfolio. It doesn't have a unit of measure, it's not dollars, but you can almost imagine it as if it was dollars. So you could imagine, it's not the way the index is built, but logically you could imagine that at the end of January in 1900, to buy one stock of these 500 companies, you have to spend $6.1. Okay, if you want, you can imagine that that is dollars. Okay, earning per share is how much earnings you get for every share of the index, given all the earnings of these companies, and you get 48 cents. Dividend per share, this is you get 21 cents or 22 cents for every share of the index that you have. And this is the CPI, okay? Now, anybody knows what CPI stands for? Okay, Alexander is correct. CPI is the consumer price index. So this is a measure of inflation. We are gonna need it because we are gonna work with inflation, okay? And the way inflation is measured is normally with the price index. In this case, in the US, we tend to use the consumer price index. There are 10, probably 20 different price indices that you can get. This is the basic one. And basically it tells you how much a certain group of goods, in this case, consumer goods, because the consumer price index, is worth in dollars in every point in time, okay? So basically it's telling you that today, or sorry, rather at the end of 2019, you needed $266 to pay the same amount of goods that in 1900 was costing $8, $7.9, okay? Now, we all understand that this is a lot of limitation because the goods that existed in 1900 don't exist anymore. So you can't say what was the price of a laptop in 1900 because it didn't exist. But basically, that tells you the relative value of money in different points in time. Okay. So let's start. We move to DDM. So let's start calculating the DDM for the US stock market today. Okay. Now, the first thing that we need is the dividend yield. And the dividend yield is just the value of the dividend per share today divided by the price today. Sorry, I keep saying today means the last available number that we have. So we are assuming that we are on the 1st of January, we are still a bit hungover and we are doing this calculation, no? At the beginning of the year. Okay, so at the beginning of the year, the dividend yield is 1.8%. Okay, so now we need to estimate the growth rate of dividends. Now, to estimate the growth rate of dividends, we want to use the real dividends. Sorry, do you have the real dividends in your table or not? Because, okay, sorry, I made a mistake. Okay, we are going to redo it together. I didn't clean up my table because. So we need the real dividends. So we're going to create a new column that we are going to call real dividends. Okay. And basically, the value of dividends, we need to bring all the dividends in today's dollars. Okay. Actually, we don't really care about whether it's today dollar or $1,900 or $1,950. Okay. But basically, we want the dividends at every single point in time to be expressed in the same currency value. Okay. So normally what you do is to express it in today's dollar. Okay. And the way it works, so let me go to the first line. The way it goes is you take your dividends. Okay. Then you multiply it by the CPI today. Okay. And I'm going to do F4, so I'm going to put the dollars around the formula, and then divided by the CPI at the time of your dividend. Okay, let me just write it, and then I'm going to. Okay. Okay, so this is the calculation. The calculation is D2, the dividends in 1900, multiplied by the CPI today with the dollars. So when we drag the formula, this doesn't change. Divided by the CPI at the time of our dividend, so in 1900. So is D2 divided by E111441 divided by E2. Okay. Now, as you can see, dividends that were $0.2 in 1900 are worth $7 in today's currency. Okay. So basically now we have expressed the dividend of 1900 in today's dollars. And then we can simply double click to drag the formula down. Okay. So now all the dividends are expressed in today's dollars. Of course, the last number will never change because that's the dividend of today expressed in today's dollar. Okay, so now how do we calculate the growth rate of dividend? So let's assume, Christopher, if your formula is correct, it's just a matter of formatting. So just change the format. I suggest you take the column E, you copy the format, and then you apply the format here. Okay. Does it work? Okay, hopefully it will work. Okay, so now that we have the real dividends, we need to calculate estimate the future growth rate. And we are going to do it basically assuming that the future growth rate is going to be equal to the growth rate in the last 10 years. Okay, so we're going to use a 10-year growth rate. And the way we do it is we do the dividend today divided by the dividend 10 years ago. Okay, so we're going to take minus 120. So it's going to be January 2010, I guess. Let me see if I'm correct. Minus 1. Sorry, I'm just going to type the formula and then I'm going to show it to you. So basically is F1441 divided by F1321 minus 1. That's basically dividend in time t minus dividend in time t minus 10 divided by dividend in t minus 10. Okay? If we do this, we get 118%. So that's the total growth of the dividends over 10 years. We don't care about the total growth of dividends over 10 years. What we want is the annual growth. So we need to put another parenthesis. And then we need to do at the power of 1 over 10 minus 1. Okay? So that's what we've been doing. Sorry, there is an error. I getting a weird result. Let me check. Ah, okay, I forgot a parenthesis. Okay. Okay, so that's better. So, just for people, sorry, sometimes people get a bit confused with the formulas. Just so we don't get confused, let me just show it, because this is a very common thing that we're going to do multiple times. So let me just do it once. And then we are good. So if we want to measure the growth of the dividend from time 0 to time 10, I want to know what is the growth of dividend. Sorry, we are going backward. So we want the dividend from, okay, let's say from time 0 to time 10. Okay, what do? You do D10 minus D0 divided by D0. Okay, we all agree with this. This is the return. This is the total growth of the dividend. Does it make sense? Can I get a yes or no? Does it make sense? Okay, so this is the same as doing D10 divided by D0 minus 1. This is mathematically the same. Okay? Now, if you do this, that will give you the total growth of the dividend over the 10 years. Okay? Now, let's call it this G10. This is the total growth over 10 years. Now, I don't want the total growth over 10 years. I want the yearly growth, the average yearly growth. Now, you cannot do simply G10 divided by 10. That only works with logarithmic returns, not with the normal returns. What we actually need to solve, we need to say, hey, look, G10 is equal to 1 plus G at the power of 10 minus 1. Okay, so we say, look, the 10-year return is equal to the 1-year return capitalized for 10 years. Okay, and so here what we do is to say, I can't move too much. And so what we're going to say here is, let me open another page. If G10 is equal to 1 plus G at the power of 10 minus 1, then G is equal to what? Okay, I'll give you a few seconds to solve this. Is equal to 1 plus G10 at the power of 1 over 10 minus 1. Okay, so that's exactly what we've done. It takes a little bit to get used to these formulas, but the good thing is that you will never have to use them, because when we do MATLAB, we don't bother with these calculations. But basically, that's exactly what this formula says. Okay. Okay. Now, what we are doing here, we see that on average, dividends have grown over the last 10 years by 8% per year. Okay. Sorry, I have a problem with my screen. Okay. So dividends have grown globally of 118%, and that basically means 8% per year. Okay. So the expected return according to the DDM model is simply the dividend yield plus the growth rate of dividend. And that's it. This is the expected return in real terms. Then we need to apply the expected inflation. And this is the expected inflation according to AQR. They use 2.1%. And so the expected return in nominal terms is the expected return in real terms plus the expected inflation. Okay. Now, any problem with this calculation? Any problems with this calculation? Any question? I repeat, you may take a little bit to get used to the formulas, but should work. Now, the problem is this number. This number makes no sense whatsoever. If we go back to AQR, we see that their forecasting is 4%. Okay? And especially their forecasting with the payout based, that is the one that we're using today, is 4.6% before inflation. Okay? Instead of having 4.6% before inflation, we have 9.9% before inflation. That makes no sense. So what's the problem? The problem is G. G is our problem here. We have a big problem with G. Why? Well, let me just plot a graph of dividends. Okay, you don't need to do it. Let me just plot a graph of the dividends. Okay, so these are dividends before inflation. Okay, and what you have here. Sorry, give me just a second to adjust. What we have here is that if you look at the numbers, the growth rate of dividends in the last 10 years has nothing to do with the growth rate of dividends in the past. Okay? So there are two problems here. One is what Julian is referring. 10 years ago was the global financial crisis. Well, technically now it's 12 years ago, but was the global financial crisis. And so dividends fell here. Okay? So since dividends fell in this period, okay, dividends went down pretty badly here, then they had to recover. And so what we are measuring here is also a recovery of the dividends after the drop in the global financial crisis. So first of all, if we use 10 years nowadays, we are basically measuring from the trough of the global financial crisis. So that's a technical problem. But even if you forget about the global financial crisis and you take the dividends from 2003, etc., still we see that the growth rate of dividends is pretty different from the historical one. Okay, the growth rate of dividends in the last 20 years is not representative of the historical one. Okay, and so this is a bit of a problem. That's why I've since revised my teaching notes. Well, technically I haven't revised the teaching notes yet, but I gave you the announcement on the slides. We should not use a 10-year dividends. Okay, it's better to do something different. So if I can go a second to the solution, to the solved version of Excel, you will find here that I've redone the calculation with all the formulas for the forecasting growth of dividend using 10, 20, 30, 40, 50 years of data. And so if you look at it, you will see that in order to get the same expected return that AQR gets, I remember AQR gets 4.6% on the payout based method for the US, we need to use 40 years of data. Okay, so if we forecast dividends with 40 years of data, we get exactly the same expected return that AQR gets. Okay, basically we should use at least 30 years of data if we want to get some reasonable number here. The idea is if we measure the expected returns, sorry, if we measure the expected growth rate of dividends only using 10 years of data, we're going to get numbers that are totally unrealistic compared to the expectation of all the other banks. Okay, so I don't know what's going to happen on the next 10 years. It may very well be that the stock market will do plus 10%. Okay, we don't know. But if we want to be consistent with the other banks, we should use 30 to 40 years. Okay, because that's the number that gives us that expected return. Okay, any question on this? Okay, if there are no questions, we can take a break, 10 minutes, and then we come back and we look at the other two methodologies. We are going to go much faster because now we know the mechanics. And so you will see that the other methodologies are just a refinement on this one. Okay, so 10 minutes break from now, and we come back at 1:31. Okay, we are back. Can I get a yes if everybody's back? I need to be sure that at least we have some people back before we start. Okay, good. Thank you very much. So what are we going to do now? We are going to move to a second methodology. And if you remember the presentation of your colleagues, they were saying, group 9 was saying, I apologize, I didn't check the name of the person who was speaking, so I don't remember who was speaking, but basically group 9 was saying, hey, look, the first methodology that AQR uses is based on payouts, and the second is based on earnings, okay? Now, the idea is that we're going to see in a second, dividends are very unreliable, so people prefer to use earnings. Fair enough. Now, before we move and look at the methodology, how AQR implements it, because it's a bit not complicated, but there are a couple of annoying details, we need to introduce the concept of CAPE, or cyclically adjusted price earning. Okay, so let me just go to the slides a second. Okay, so the first, I call this model the CAPE model. It's not necessarily the CAPE model, but it's based on the concept of CAPE. So what is CAPE? In the dividend-based model, we started by looking at something that was the dividend over price, okay? So a fundamental aspect of this model was this thing here, the dividend over price, okay? Now, we are going to transform this model from dividend-based to earnings-based. And so we need to deal with the equivalent, that is earnings to price or price to earning, okay? Now, we are all familiar with the concept of price earning, okay? We have seen it many times in finance, in different places. But while we are going to use earning to price instead of dividend to price, we are going to make a change. In 1988, Campbell and Schiller published a very important paper where they show that there is a very negative relationship between price earning and future returns. Okay, that's exactly what we want. We want something that can predict returns. So they say, look, price earning is a negative correlation with returns, but you need to adjust the price earning, okay? And you need to adjust it in two ways. So they say, we're going to create something that we're going to call cyclically adjusted price earning ratio, or CAPE, okay? And basically, this is a version of the price earning where we consider earnings and prices in real terms. So we're going to take away inflation. And instead of dividing the price by the earnings of the last year, we're going to divide the price by the average earnings over the last 10 years. Okay, so these are the two changes that Schiller does to the price earning to create what they call the cyclically adjusted price earning. Okay, now before we look at some data and graphs and stuff, let's just spend a second in reasoning. What does it tell you when the market has a price earning of 10 or the market has a price earning of 30? Okay. Now, these are two different situations. Let's call it situation A and situation B. Okay. In both cases, we know the price that people are willing to pay for a stock or for the market should be proportional to the earnings that you get out of the stock or the earnings that you get out of the market. So what does it mean that the price earning is 30 rather than 10? What is the economic difference between the situation B and the situation A? Anybody has any intuition in chat? Why sometimes we are willing to pay 30 times the earning per share and sometimes we are willing to pay 10 times the earning per share? Okay, Alexander says expected growth, and Sebastian says expected growth. So, and the other Alexander also says expected growth. So the idea is that, yes, we know that multiples are driven by growth. And so in the situation B, we are willing to pay 30 times earnings because we expect the earnings to grow more. Now, if A and B were two companies, it would be totally appropriate for a company to have a price earning of 30 and a company to have a price earning of 10. We would say, look, company B is a high growth company. The market has expectation that the business of this company will grow very fast and the earnings will grow very fast, so the market is willing to pay 30 times earnings. Company A, on the other side, is a slow growth company. There are not much prospect, etc. So we are only paid 10 times earnings. When you apply this to a company, it makes perfectly sense. When you apply it to the market, is a bit different because the expected growth rate of earnings for the entire economy doesn't change that much. And so when it comes to the market, what you have in reality, sorry, my share has died. When it comes to the market, what you have in reality is something more like this picture, okay? This picture gives you the price earning, that's the blue line, and the S&P 500, that's the index, okay? Now, as you can see, when the price earning is very high, okay, like it was very high, for example, here, that's 1929, okay? When the price earning is very high, like 30, you can't really say the market is expecting the economy to grow a lot. What we normally say, well, the price earning is very high, we are paying a lot for earnings, so the market is overvalued. And as you can see, we clearly can see these peaks of overvaluation in 1929 and at the top of the tech bubble in 2000, okay? So normally, when the price earning is very, very high, especially if we see this sort of peaks, for a normal company, you will say, hey, look, we expected this company to grow a lot, so that may be justified. But for the market as a whole, we say, look, on average, we pay 17 times or 16.9 times earnings. So if today we are paying 30, 35, or 45, like in the global, like in the tech bubble, very likely the market is overvalued. Okay? On the other side, when the market is very cheap, like after all the oil crisis in the 80s, that is probably a good signal for investment. Okay? And that's why Schiller and Campbell find this negative correlation between CAPE and future returns. When CAPE is very high, future returns tend to be very low because the market goes down. When CAPE is very low, future returns tend to be very good because the market is cheap. Okay? Anybody has doubt on this? On this idea of price earning, okay? I repeat, the only innovation that Schiller applies to the concept of price earning is that instead of taking the price in time t divided by the earnings in time t, we take the price in time t and we divide it by the average earnings in the last 10 years, okay? And the idea is that this is more stable because it adjusts for business cycles, okay? The idea is earnings can go up and down every 3 months, every 6 months. There is a Christmas spike of earnings, then the earnings go down in the first quarter. So earnings, there is a business cycle that is expected. So what really matters is the average over the last 10 years. That tells you whether the market is undervalued or overvalued. So that's the intuition of Schiller. Any question on this, on the general topic of CAPE? Now we need to see how it applies to forecast and valuations. Any question? Okay, if there are no questions, before we move to the model, let me just show you a couple of things. Two things that are just in case you care, okay? all the data that I've shown you on US equity that we are using in the exercise, you can simply find them by Googling Shiller Cape data. If you Google Shiller Cape data, you will find the page where Bob Shiller, that is a Nobel Prize winner, publishes all his data on the US stock market. And especially you find this file that has all the data on the US stock market from 1871 to yesterday, well, to last month. And among other things, you find all the data on Cape, so the graphs and all the data that we've been using come from these tables, okay? Just retouched a little bit. So if you want to work with Cape, look at historical data in the US, Bob Shiller published, and this is updated every couple of months. So that's very good, just in case you care, but I repeat, I will give you all the necessary data. Now, the other thing is that Cape as a concept, not the model that we're going to build in a second, but Cape is incredibly famous, so it's good to get used to it because it's used a lot. So just to give you a couple of examples, the two articles that I gave you as a hot from the press for this week, just for your own readings, are from the Financial Times, and they deal, the Financial Times uses Cape to judge whether the market is overvalued or not. Always, okay? The Financial Times uses the Cape all of the time, okay? And so in this article from June 20, they are basically discussing the fact that everybody is talking about that even if the coronavirus has wrecked the economy, the US stock market hasn't stopped, went down very fast for a couple of months and then came up back, okay? And the way they talk about this, I'm just gonna skip, says, nonetheless, US equity are looking particularly frothy, with a cyclically adjusted price to earning ratio nearly 30, almost twice the long-term average. Almost 4 in 5 fund managers, blah, 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 etc., think the stock market is overvalued. Okay? So basically, they think the stock market is overvalued. Why they think that? Well, because if I go back to the Shiller's data, I'm just going to go to the graph. Forget about the red line. The red line is interest rates. Doesn't matter for us. As you can see, today, Cape is 30 or 29.9, and that's very high, okay? It has been higher than that, higher than 30, only twice. One was during the tech bubble of 1920, sorry, of 2000, and one was in 1929. And those were the only two situations where the Cape was higher than 30, okay? And so the Financial Times says, hey, look, many investors, many professional investors think that the market is overvalued. Or in the second article that is from April, where it's looking at basically the valuation of emerging market versus the US, again, the way they talk about this is Cape says, stocks across the developing world now trade 7.8 times profit on a cyclical adjusted price earning basis, a 65% discount to the Cape of 22.6 of the US stock market. Okay, this is from April, so the Cape at the time was 22.6. But they say basically emerging markets are trading at Cape of 8, so they trade a 65% discount over the US. And that's basically where they plot the Cape, and they tell you that according to them, emerging markets are undervalued compared to the US. Why? Because they trade at a lower Cape. So this was just to show you that Cape in itself is an incredibly useful concept because it comes around all of the time, okay? Many investors, if you ask them, where is the stock market in terms of valuation, they look at Cape. And when they need to compare different stock markets, they look at Cape. So in this case here, what is telling you, hey, look, emerging market in the US used to trade a rather similar Cape, and now they are different, blah, blah, blah. Okay? So this is just to discuss the concept of Cape. Now, if we understand Cape, now we can move to use Cape to provide unexpected return. okay? We are going to do this in two ways. So we're going to, first of all, we're going to do the AQR methodology. And then we are going to do a cheat version that works as well with 1/3 of the calculations. Okay, so it's very important to understand that the AQR methodology based on earnings seems very complicated, is exactly the same thing in the dividend discount model, just translated from dividends to earnings, okay? So, first of all, we need to remember what is a dividend. Dividends are the portion of earnings that a company pays off, okay, pays out to investors. And normally we call payout ratio the percentage of earnings that is paid out as dividends, okay? So if a company has earning per share of $1 and the payout ratio is 60%, the dividends will be 0.6, okay? I assume this is easy. So the way we translate the dividend discount model expectation in terms of earnings is simply to replace dividends with earnings multiplied by payout ratio, okay? So we simply replace dividends with earnings multiplied by payout ratio. And then, of course, we replace the growth rate of dividend with the growth rate of earnings. Okay, any question up to this point? This is just to show you, look, the earnings-based methodology, the reason why we start with the dividend, even if it doesn't work very well, is because the earnings-based are just the dividend methodology restated in terms of earnings. So it's good to start from the logical beginning, okay? So, done. Now, when we apply the earnings-based methodology, we have one additional problem, that if forecasting dividends is difficult, forecasting the growth rate of earnings, so this thing is even more difficult, because dividends are much more stable than earnings. And this is a graph that shows you earnings and dividends in the US on real terms. Now, if you remember, we were complaining that the growth rate of dividend in the last 10 years was not stable, and that this growth rate was not representative of this growth rate, okay? Now, look at earnings. Earnings is a complete nightmare, okay? So first of all, you understand why CAPE is important, because it takes away some of this jiggle that is just business cycle, but also forecasting the future earnings is very, very difficult, especially based on the past, because it's true that there is a bit of a trend, but it's quite erratic. And you can have big swings like here. This is the global financial crisis. As you can see, earnings were basically to zero. Dividend went down, but earnings went down much more, and then they picked up immediately. So forecasting the growth rate of earnings is even more difficult, okay? So to address this issue, AQR applies a cheat. So what do they do? Well, what they do is, instead of forecasting the growth rate of earnings using the last 2 years, or the last 10 years, or the last 20 years, or the last 30 years, what we take is all the available data, all the data that we have in the US, and we measure the super long run growth rate of earnings. If you read their paper, they use data from 1940, and they come up with an expected return of 1.5. Sorry, with a growth rate of earning of 1.5. So they say, look, growth rate of earnings is 1.5. That's it, okay? That's it. Second, the payout ratio, so the percentage of earnings that are paid out as dividend, also changes in time. But again, they say, well, let's just look at what happened over the last, since we have data. And so they say the payout ratio on average is 50%. So they are going to solve the model cheating a little bit. They are going to say, okay, look, payout ratio is 0.5. GE, the growth rate of earnings, is 1.5%, and that's it. Then we're going to apply the model. Okay. Now, there is one additional little complication, that is this weird thing here. Okay. Sorry, I wanted to do this weird thing here. Okay. So what is this weird thing? That weird thing is the following. They say, look, we want to apply this thing. Okay. We want to do this, but the normal price earning ratio doesn't work. So we don't want to use the normal price earning ratio. We want to use the CAPE. And CAPE doesn't use the earnings today. CAPE uses the average earnings over the last 10 years. Okay. And so they say this makes the whole model more stable and more performing. But the problem is that these average earnings over the last 10 years are a bit outdated. They are old in the sense that on average, they are 5 years old. Okay. And so to get a correct measure, we need to update these average earnings, making it grow by 5 times the growth rate of earnings by 5 years. Okay. Because basically, remember that basically what you have here is the average earnings over the last 10 years. So 0, -1, -2, -3, -4, -5, -6, -7, -8, -9, -10. Okay. Sorry. Let's get rid of this one. Okay. So as you can see, I do the average of these 10 numbers. Okay. Now, what they say is that this average is old because this number is very recent, but this number is very old. So on average, these earnings are 5 years old. And so if I want a correct measure of the current earning generation power of the economy, I need to update it by 5 years. And that's why they do this component where they basically do 1 plus 5 times the growth rate of earnings. So basically this number, earnings, the average earnings per share, gets brought forward by 5 years. Okay, it looks a bit weird. When you do it, it makes sense and it's relatively easy. Okay, so the idea is, on average, this average earning per share is 5 years old. So it's not representative of what the economy can do today. It's good because it takes away spikes. So I like the average. They like the average because it takes away the spikes. But it's on average old. So we need to grow it by 5 times G. Okay, so basically we bring it back to the current value. Okay, so that's what they do. Let's move now to Excel, and we're going to have a quick look at how to calculate this stuff. Just to be clear, I will not ask you to work with the AQR document anymore, but it's good, you know, to read what they do. Okay. And so, for example, here they say, we start from the inverse of CAPE, so E over P. We multiply by 0.5, so that's the average payout ratio. And then says, add the real earnings growth of 1.5. Okay. And then you look at the note, it says the adjusted Schiller EP is earning price multiplied by 1.075. This is exactly the 5 times G. Okay, 1.075 is the 5 times G. Okay. So let's do the calculation. So first of all, we need to calculate the CAPE. And to calculate the CAPE, we need the real price and the real earning. Real price and real EPS. Okay, we already know how to do that. So we know that real price is simply the price today times the CPI of the last period, 11441, I remember that, divided by the CPI today. And the same thing for the real EPS. The real EPS is the EPS today times the consumer price index, sorry, the EPS in 1900 times the consumer price index today divided by the consumer price index in 1999. So that's simply the price adjustment. Okay, then once we have real price and real earning per share, we need to calculate the average EPS. Now, the average EPS, now, CAPE is always calculated where we use the average EPS of the last 10 years. Okay, this never changes. That's the way Schiller built it. So, of course, we can only do that from observation 121. And we just do the average of the real EPS. So this is just the average of the last 10 years of EPS. We can push it. And then we can calculate the CAPE. And CAPE is just the real price divided by the average EPS. Okay. So now that we have a CAPE, we can just say, okay, CAPE is just real price divided by real EPS, sorry, by the average EPS, so it's 30. Earning to price, I don't need CAPE, I need the inverse of CAPE, so it's just 1 over CAPE. Okay, I don't know. Okay, it's 3% in percentage point. So this is the earning yield. The earning yield is 3%. That's E over P. The average EPS divided by E over P. Okay? Then the growth rate of earnings, according to EPS, according to AQR, is just 1.5%. Because they cheat, they just choose a number. And the payout ratio is just 50% or 0.5. Okay? So, what is the AQR methodology? Well, it's very simple. It's just payout ratio times earning to price times 1 plus 5 times G plus G. That's your AQR, okay? So the formula looks weird, but is exactly what they have. And is exactly the one that we have seen in the slides. So is payout ratio times earning to price. Then we need to adjust the earning to price multiplied by 1 plus 5 times the growth rate to update the earnings, plus the growth rate of earnings. That's 3.2, okay? Plus 2.1 of inflation, and this gives me the nominal of 5.3%, okay? Now, if you go to the AQR paper, we get roughly the same number. 3.28, they get 3.3. Okay, so that's exactly the adjusted Schiller for them is this one times 1.5 times G. So that's what gives them 3.6. Okay, and then they get exactly 3.3 in the same way we get 3.3. Okay, any question on this methodology? Again, there are two things to remember. One is that logically, it's just a dividend discount model transcribed over earnings. Okay, dividend discount model transcribed over earnings. Okay, so you need to apply the payout ratio and plus a couple of marginal adjustments. And the second thing is that we don't use, before we were using the dividend to price. We would like to use the earning to price, but earnings are too volatile. And so we use the CAPE. That is the earning to price, where the earnings is the average earnings over the last 10 years, okay? Because that will cut off some of the spikes of earnings that are just quarterly or 6 months because of business cycle or seasonality, etc. Okay, any question on this? Now, it's also very important to remember that CAPE is used in itself a lot as a way to judge the valuation of the market. Now, for the people that are a bit upset because of this formula looks a bit complicated, okay, so there are a couple of questions. Let me address. By the way, if I don't see you typing in chat, Rakib, will be assessed on these materials? Yes, you will, because that's part of the subject. But remember that the exam is going to be open book. So you don't have to remember the formulas, but you need to understand them, okay? And Heidi, do we need this for the assignment? Yes, because the first part of the assignment will be to forecast returns. Okay, I don't know, Alexander, what, sorry, what do you mean, Christopher, that the solution in UTS Online aren't the same as the one that I showed? Can you point me to any specific, because it should be the same file. Ah, okay, yeah, I didn't do the CAPE column because actually you don't need it. You just need the last value of CAPE. So that CAPE column is look, we can't have 2 hour classes. Okay. Alexander, as I say, this is not, will be an open book exam. So I may tell you, hey, look, go on the AQR material. What do they mean where they do this? Or yes, I could ask you something like that. Okay. But let's not worry too much about the exams now. Okay. So let's move 1 second back to the slides. Sorry, going back to Luke, we don't do 2 hours because normally we do 2 hours and then we do the MATLAB. But today is one of the 2 lectures where there is no MATLAB. So yes, you need to support, you need to get through 3 hours of slides. I apologize for that, but it will only happen twice. So, okay, now there is a very funny situation here. While we were doing while I was working on that paper with that former colleague of mine who used to work in this London bank, we were looking at this AQR methodology that looks very complicated. I mean, the formula looks quite involved. There is a lot of parts. And we come up to realize one thing that is very weird. There is another way to calculate the expected return given this model that is simply to take the inverse of CAPE. If you take the inverse of CAPE, so you just take earnings, the average earnings of the last 10 years divided by price, the simple inverse of CAPE, that will give you a number that is incredibly close to this whole thing. Okay? So some banks, they want to use this methodology, something similar, something earnings-based as a methodology for forecasting returns. But instead of doing this whole thing here, they just take 1 over CAPE. And as you can see from this graph, the two are almost basically the same. Okay, so just for you to know, sometimes you will find a bank that they do some forms of earning based, but instead of doing all this, they just do 1 over CAPE and they get basically the same number. So just for you to know that the AQR methodology is maybe a little bit overcomplicated. And by the way, keep also in mind that if you read the AQR document carefully, they cheat even more because they say, hey, look, this 1.5 that we have estimated using US data, we are going to apply it to every market, excluding emerging market where they do 2%. They don't really explain why. Well, the reason is that there is much more long-term data for the US, so it's easier to do the super long-term average growth of earnings. For European market, the history is much shorter. And so they say, we prefer a long-term average return growth rate, GE, of 1.5 for every single market, okay? So just for you to know, they cheat a little bit there. Okay, so this is, does CAPE work? Well, it's more responsive than the dividend discount model. So as you can see, it works reasonably well in the 60s as the dividend discount model, but then it responds much better here in these periods, okay? Of course, it will still be unable to capture very extreme market conditions. So for example, it doesn't capture very well the explosion of the dot-com bubble. It tells you market returns is going to be shitty. Sorry, it's going to be bad. Tells you it's going to be very low, 2% over the next 10 years. But it doesn't capture the negative return. It doesn't forecast the negative return. But generally, recently has been a reasonably good estimate. Okay, until 10 years ago, we can't measure realized returns after 2009. Okay, now there is one last methodology that we're going to introduce this week, and probably we're going to finish the next week, that captures one missing point of this equation. Okay, now let me start from showing you. These are bits and pieces from two other banks, Invesco and Research Affiliates. Okay, if you look at Invesco, they say our building block approach to estimating returns is the sum of two components. The yield that we know, earning to price, the earnings growth that we know, but then they add a third component that is the valuation change. Okay, and Research Affiliates does the same thing. Says our return is the dividend yield plus earnings growth, so that's where we are so far, plus delta valuation, that means valuation change. Let's forget about the currency adjustment because that happens when you use other countries, okay? But basically, both of them add a third component. So far, we have seen yield plus growth, yield plus growth. But what they do is to add a third component that is called valuation change. And if I can go back a second, this is pretty common. I just want to show you that we are not doing something that is needlessly complicated, because basically many other banks do the same. Okay, if I can find the other banks, give me just a second. So this is Rockefeller, and Rockefeller says our expected return growth model is the sum of four things: carry, that is the yield, they call it carry, growth, inflation, okay, and valuation change, okay? This is Invesco that we've already seen, and Invesco has gain, yield, earnings growth, valuation change. So most of them use 3 components, okay? Now, AQR also say that the equity return is the yield plus the expected growth plus the expected valuation change, okay? Only that they say, we assume that the change in valuation is equal to 0, okay? So basically, also AQR uses valuation change, but they say, look, we cannot forecast that, so we're going to assume that is equal to 0, okay? So it's very important that we spend some time on this third model because it's the one that actually most banks use. Okay, let me go back to the slides. So what is this valuation change? Now, the idea is the following. Let's go back to the basics, okay? The price of the stock, or if you want, in general terms, a stock is worth more under one of 2 conditions. Condition 1, the company produces more earnings, okay? Or condition 2, investors are willing to pay more for the same amount of earnings, okay? And the second element is what we normally call valuation change. And I feel always very stupid when I do this, but I think it helps to get the idea. The price of a stock, okay, we can write this as the product of 2 components. The earning per share times the price earning. Okay, now this is a stupid equation. This is, no, it's very stupid. But it tells you that there are 2 reasons why the price can go up of a stock. Either the earning per share goes up, the company produces more earnings, or investors are willing to pay more for the same amount of earnings. So this is important because it means that the price of a stock can go up, so we can generate returns, even if the earnings don't change. But investors become, in time, willing to pay more for the same amount of earnings, okay? And we have seen this, okay? If I go back a second to these slides where we had the CAPE, okay? The CAPE is a price earning. And so, as you can see, for example, between, let's say, 1980 and 2000, the stock market goes up a lot. And in that period, the stock market goes up for 2 reasons. So on the one side, so here, the stock market goes up a lot, okay? Now, on the one side, earning per share went up. But on the other side, investors were willing to pay more for the same amount of earnings. Here, in January 80, investors were willing to pay $10 for every dollar of earning per share. But here, in January 2000, investors are willing to pay $40 for every dollar of earning per share. Okay, so valuation change captures exactly this idea. The idea that you may have, in a specific period of time, a change in the amount of that investors are willing to pay for the same amount of earnings. Okay. Okay. So this has been studied, in a couple of papers by Ferreira Santa Clara, Ibbotson and Change. We're not going to go into the original research, but the idea is that the price of the company will grow if the company creates more value, or if shareholders are willing to pay more for the same amount of earnings. Okay, so that's it. Now, I'm going to do now a little bit of a mathematical derivation that is quite meaningless. Okay, but it helps us to understand how we reach the final formula, and the final formula is incredibly simple. Okay, so the idea is the following. Let's start from the idea that price in time t is equal to earnings in price t times the price earning in times t. Okay, now of course the same is true for the period before. Okay, the price in t minus 1 is equal to the earnings in t minus 1 times the price earning in t minus 1. Okay, now if we define the return of the stock in time t as pt divided by pt minus 1 that we saw before, and we substitute the price with this and this, okay, we substitute the pt and pt minus 1 with their equivalents, we get this very weird equation. Now you can play a little bit with the arithmetics. You can move stuff left and right, and we're going to get the return is equal to earnings in time t divided by earnings in t minus 1 divided by, multiplied by price t over price earning t over price earning in t minus 1 minus 1. Now we can remember that et divided by et minus 1 is 1 plus the growth rate of earnings, and price earning t divided price earning t minus 1 is equal to 1 plus the growth rate of the price earning. And so we put everything together and we say, look, the return in stock t, the change in price in stock t, or the return in stock t, is equal to 1 plus the growth rate of earnings times 1 plus the growth rate of price earning minus 1. Okay? Okay, sometimes you will find the same formula expressed in this way is less precise, but some people do it like that. But this is the correct one. Okay? So the return of a company is equal to 1 plus the growth rate of earnings times 1 plus the growth rate of price earning minus 1. Now, of course, we defined the return at the beginning just with the change in price. There are also dividends. And so to get to our final prediction, we need dividend price. So that's the dividend yield plus 1 plus the growth rate of earnings times 1 the growth rate of price earning minus 1. Okay? Or, if you prefer, dividend to price plus the growth rate of earnings plus the growth rate of price earning. Okay? So this is the sum of part. And if you look at the sum of part in this more simple clarification, is exactly the model that we used before plus this. Okay? So we simply took the AQR model or any model based on earnings that has yield plus growth, and we added a third component that is the expected growth rate of the price earning. Okay? So at the end, you know, regardless of the derivation that is a bit Byzantine and, you know, sometimes, you know, it looks a bit weird. That's why I had to use the color so we don't get too confused. But apart from that, what you get at the end is the same model as always, where you have a yield plus a growth, but this time we add a third component that is the change in price earning, the expected growth in the price earning ratio. Okay, now of course, as all the other models, research has shown that they work better if you do them in real terms. And so we're going to measure growth rate of earnings, growth rate of price earnings in real term, and then we are going to add back our expected inflation. Okay, exactly as we did in the other cases. Okay, so let me just discuss a little bit, because if you think about it, we can simply take the AQR and add the last missing component. And so if we take the AQR approach, this is very easy, because this we can observe. This is 1.5% or whatever we measured before. Okay, we already have that. We looked at that. Okay, we already looked at it. The only piece that we are missing here is the growth rate of price earning. This we need to find out. Okay. Now, anybody has any intuition? How do we forecast the growth rate of price earning. Anybody has any idea? How do we forecast the growth rate of price earning? Because we said, look, to forecast the growth rate of earnings, we look at the historical growth rate. Okay? To forecast the growth rate of dividend, we look at the historical growth rate. How do we forecast the dynamics of the price earning in the next 10 years? Any intuition? Anything comes to mind? Okay, Alexander, I don't know if you went ahead and look at the slides, but that would be smart anyway. Mean reversion to historical value. So that's the key idea, is that the price earning works differently compared to all the other quantities that we have seen so far. Okay, if you remember, when we look at dividends, say, look, dividends have a trend that continues in time. Dividends have a trend that continues in time. And we said, look, earnings are a bit messier than dividends. Okay, so we said, look, for earnings here are a bit messier than dividends, but even for earnings, you can see a sort of a trend that continues in time. Okay, you need to calculate it in a much more robust way. You need a very long-term average because you want to avoid all the spikes, etc. But there is a trend. But when we look at the price earning, and especially at CAPE, it's a completely different ballpark. There is no trend here. What we see is what is commonly called as a sort of a mean reversion process, in the sense that when the price earning is very high, my expectation is not that it will continue to grow, is that it will come back. And that is why the Financial Times says, hey, look, the price earning of the US stock market today is 30, that's too high. It means the stock market is overvalued. Because every time the price earning goes up a lot, then it comes down. And we say is mean reverting over some sort of long-term average of some sort. Okay? So that is what we're going to build. We're going to build a forecast based on this mean reversion. I'm going to show you the way it can be done. Then we are going to look at a couple of examples of banks, the way they do it. But it's not very complicated. So the idea is the following. By the way, some banks don't want to get bothered with this. And so like AQR says, growth rate of price earning is equal to 0. Okay, AQR says, we understand that there is a valuation change. We don't want to get bothered with estimating it, so we say it's equal to 0. Research affiliates, if you go on the website, they have two methodologies. One with valuation equal to 0, and one where they estimate the valuation. Okay, so there are different approaches here. Okay, so the idea is the following. We're going to model the mean reversion. Sorry, I skipped on these slides because that's exactly what I described before. Okay, so we're going to measure the mean reversion. How does it work? Well, first of all, we are going to calculate the long-term price earning, the long-term average of the price earning. Okay, for example, the price earning over the last 20 years. Okay, and then we are going to assume that from today, we will go back to the long-term average over the next 20 years. This is called a 20 years mean reversion. So the idea is we are going to take the average long-term average price earning, and then we are going to assume that we are going to go back there over the next 20 years. And so the idea is long-term price earning is equal to the price earning today times 1 plus growth of price earning at the power of 20. You solve this and you get your mean reversion. Numerical example. Let's assume that the price earning today is 7 and the long-term price earning is 15. So today, the market is this is roughly the numbers of 1980, where the market was very cheap. Okay, price earning in 1980 was 7, the long-term price earning was 15. And so if you do the calculation, the growth rate of price earning will become 3.8. So the price earning has to grow 3.88% per year to go in 20 years from 7 to 15. Okay. Instead, let's take a situation roughly similar to 2000. The price earning was 35 and the long-term price earning was 15. So in 2000, the market is incredibly expensive. You apply the measure, you apply the formula, and you will get that the growth rate of price earning is minus 4%. And so this basically tells you, look, today the market is very expensive. So we expect a negative valuation change. We expect valuations to go down. And so to go from 35 to 15 in 20 years, you need to go down by 4% per year. Okay, so that gives you a negative component of valuation change. Okay, now before we look at some numbers, is this thing, does it works? Okay, now it's difficult to apply. It's difficult to apply, but when you apply it correctly, valuation change works very well and is much more dynamics than the other forecast, because it's the only one that, for example, if you applied it in 2000, in January 2000, would have told you the expected long-term return on the US market is negative. Why? Well, because yes, you have a dividend yield. Yes, you have a expected growth rate of earnings, but you have a valuation change component that is minus 5%. Because today the price earning is very high compared to the long-term average. And so we expect that the long-term average will go down. By the way, CAPE is famous because before the burst of the dot-com bubble, Schiller published a book called Irrational Exuberance, where he used the CAPE to forecast the burst of the tech bubble. Okay, so it famously works well in that period. Doesn't mean that it will keep working well in the future. But one advantage of sum of part is that it's the only methodology that can actually give you a negative expected return for a stock market. No other methodology can do that. Okay, and can do that because if the price earning today is very much higher than the long-term average, we will tell you the market is very expensive. We expect valuations to go down. Okay, any questions on the sum of part? Okay, now I understand that everybody is a bit tired and I don't want to rush through the calculation of the sum of part. So I will do the calculations next week. So next week we spend a little bit at the beginning of the lecture to go to the calculation of the sum of part. I don't want to do them now because I would have to rush them and then it gets confusing. But you already have them in the solved version of the Excel file. So if you want, you can look at them there, okay? They are very simple. There is nothing particularly complicated there. Okay, so we're going to stop here. Next time we're going to do the calculations and then have a quick look at the bonds for a couple of minutes just to see what is the roll down return. Okay, so before we move, I repeat, I understand it would be nice to have the calculations now, but we're running a bit late and I don't want to rush through them because then it gets very confusing. You can, if you want, you can look at them in Excel. Okay, now before we go, I just want to spend a few minutes looking at the group assignment, okay? Now, in theory, from the theoretical point of view, you can start working on the group assignment from today. In practice, I suggest you wait next week when we do the MATLAB part. But if you're very eager, you can start doing the MATLAB part on your own, just in case you're eager. So let me just quickly discuss with you the assignment. Sorry, you can find the assignment. You can find the assignment in UTS Online. So let me just open it, quick second. Group assignment, you have the text of the assignment, Then you have the data that is for MATLAB, and then you have a description of the data that we're going to see next week when we look at the MATLAB part. Okay, I don't want to rush through the data for now. I've just prepared a very short PowerPoint presentation just to talk about a few elements of the assignment. Let me go to the presentation here. Okay, people that are in investment banking, they may remember, because this is quite similar in terms of structure of the group assignment. So the idea is the following. So this is a group assignment. Group size is between 2 and 4. I will authorize, there is a blanket authorization for groups of size 1. I will only ask you to email me and tell me that you're going to do the assignment alone if you want. I don't recommend it, especially because there is a bit of MATLAB coding, so it's good if you do it with somebody else. But it's up to you. I understand that under the present condition, not for everybody it's easy to set up a group and working group, etc. Okay. Deadline is 24 September. Now, the task of the assignment, as I already announced previously, is basically to build a robo-advisor, or rather to build the skeleton and the models behind the robo-advisor. Okay. The deliverable will be, okay, I forgot, I did the cut and paste from the investment banking, a PDF file with your model. There is no PowerPoint, it's just a PDF file with your model. It will be explained in the text, and a zip file with all the MATLAB files. So it will be a normal, Word document where you explain your model, and then there is a zip file with all your MATLAB files, okay? Now, technically, if you're really allergic to MATLAB, some of the calculations, especially the one for what we did today, as you see, we can do them in Excel. I don't recommend it. I recommend to do the effort to work in MATLAB, okay? If you have a problem with that, and you say, look, I would like to do part of the assignment using Excel, please just email me so I can verify that everything is fine and that you know what you're doing, okay? But you will deliver a PDF file and a zip file with your MATLAB files. Now, the detailed output is the following. Okay, I keep using PowerPoint. It's not PowerPoint, it's a Word document with the model to predict your long-term returns for equity markets. So basically, you will explain your client how you forecast the long-term returns, a model to produce the efficient portfolios, and a model that assesses the risk aversion of every client and gives them the optimal portfolio. Okay, so these are the 3 theoretical branches of your assignment: forecast long-term returns, build the efficient frontier, choose the right portfolio for the client. And then I will give you in the assignment 2 hypothetical clients, and you need to apply the model to these 2 clients, okay? I apologize, I did the presentation a bit in a rush this morning, and I let this PowerPoint stuff. It's not PowerPoint, it's just a Word document. Okay, now, when can you start working in the assignment? Well, long-term returns, today we have seen the theory. Next week we see the MATLAB, okay? So in theory, you could start working today. I strongly suggest you wait next week that we do the MATLAB part, okay? Then week 5, we're gonna do resampling that you need for the frontier. And then with 6 and 7, we're gonna do portfolio choice, okay? So in theory, after next week, you can do this. After week 5, you can do this. And after week 6 and 7, you can do this, okay? You could wait until the end. I strongly advise against that. So I would advise start as early as possible. Okay, now, in the assignment, I detail specifically the 3 aspects. Since we don't know efficient frontier and portfolio choice, we haven't done the theory, I'm not gonna present them today. I'm just gonna talk about the expected returns part, okay? So in the expected return, you will have to apply 2 methodologies, earnings-based and sum of parts. So no dividend discount model, because we have seen that doesn't work very well anyway. So you will have to apply these two methodologies to 7 different stock markets that you have in the assignment data. You have US large cap, US small caps, developed market, emerging market, Japan, UK, and a couple, 7 markets, okay? So you need to apply these methodologies to all the 7 markets, and then you need to forecast the return, okay? Now, you will have to apply both methodologies and then compare their accuracy. We're gonna see next week how you do that. And then you will have to choose one of them or a combination of both. You can either do what AQR does, do the average of 2 methodologies, or you can choose one over the other. Okay? And then in your report, after reading your report, the reader should understand how each methodology works, how well each methodology works in each market, and how you build your final forecast. Okay, so basically you need to explain to the reader what is the AQR methodology, what is sum of parts, a bit of explanation how they work. Then you need to say, hey, look, how well each one of them works in all the markets, and then how did you make your final choice? Okay. In this part, you will also have to forecast 2 bond asset classes, but not to assess the accuracy, but this is a thing that we'll see next week. Okay. Every portion of the assignment also finishes with like it's not a question, but you need to answer to address an issue. In this case, there is a paragraph called value in the valuation change where you need to discuss how the additional valuation change affects the accuracy of the forecast in the different markets. We have seen that the difference between the earnings based and sum of parts is the additional valuation change. And so you need to provide some data, a picture, some graph, a table, something, and explain to your client, hey, look, the additional valuation change, that is a bit controversial, AQR doesn't do it, this other guy does it, etc. It works well in the US, poorly in the UK, or whatever. So you need to explain what goes on, okay? Good. Now, the presentation structure, okay? Let me skip portfolio optimization, frontier, choice. We're gonna see that when we get to the points in class, but just a brief reflection on the presentation. The PDF has to be written as a technical report where you explain to your board of directors or to a regulator how your model works. So it's not a university assignment, okay? It's a technical report. You're explaining either to your boss or to a regulator, to APRA, whatever, how your model works. So it has to be professional and clear. It has to contain enough detail to allow a full understanding without overwhelming the reader, okay? So having 15 tables in a row without a single line of comment doesn't work, okay? Now your report has to be short. You have a hard limit of 10 pages. I do this because otherwise people will come with 50 pages full of graphs and no, you have 10 pages, okay? You can use an appendix outside the 10 pages to, you may want to put additional information there or some background information or something, but all the essential information has to go into the 10 pages of the report. And then your MATLAB files should be in MLX format, should be structured and commented. So basically, somebody opening your MATLAB code has to understand how you do the calculations, okay? Now, you need to assume that the reader understands MATLAB, so you don't need to explain every single function, how it works. But you need to say, okay, in this part, we apply sum of parts. In this part, we calculate the valuation change. Here we do this, here we do that. Anyway, once we see the code next week, you will see what I mean. Okay, you will find a marking guide in the assignment that explains how each portion will be assessed. So for example, the expected returns count for 20% of your mark, and it's going to be below expectation if you do errors in the calculations or if you don't explain them. What do you think, John? It's going to be plus or credit if there are no errors and the explanation is okay. If you want distinction or a distinction, your explanation has to be outstanding, professional tone, the financial language must be on point, the results must be very clearly presented, striking the right balance between giving all the details without putting too many numbers and all the stuff. Okay, so basically this is the way you're going to be assessed. Okay, you will find a line for each item where I explain what I expect. Okay, group dynamics. Now, if you decide to work in group, and I say there is a blanket authorization to work alone if you want, even if I don't recommend it. If you decide to work in group, you will receive the same mark. Okay, it's up to you to ensure that each member contributes to the final work. If a group member does not contribute to the work, you can expel this group member. There is a procedure, so it must be an unanimous decision of all the other group members after repeated warnings, no later than September 14, and I need to be informed, so I need to confirm it within 24 hours, okay? So the idea is, yes, you can expel somebody from your group if they don't work, but you need to do it properly, okay? Behaviors that can lead to expulsion are not showing up for meetings online, not answering emails or messages, not delivering stuff that is clearly wrong, etc. So if somebody doesn't work well, okay? After September 14, I don't want to hear a peep. If you haven't kicked out people by then, everybody will receive the same mark. There is nothing I can do, okay? The only reason why somebody can be expelled after September 14 is for sanctional behavior. So if somebody is being abusive or, does bad stuff, okay? Really bad stuff, okay. But September 14 is the limit to get rid of non-performing members, okay? In the assignment, we go through a series of instructions on how to improve group work. The idea is you need to be able to communicate. So as soon as you have a group, you need to set up a communication channel. Can be a team in Teams, can be WhatsApp group, can be a whatever group that you want, any social media that you want. Just please don't rely on emails, etc. I don't want to hear horror stories that I don't have the email of my group members. I don't remember their last name. I only remember it's called John. Okay, that doesn't work, okay? Also, I will not accept any plea for extensions because you lost a file. It's 2020, so please share a Google Drive, a Dropbox, so everybody has access to all the files, files don't get lost, etc. Okay. Second thing, one complaint that from time to time I receive is people that say, hey, look, my part of the assignment got full marks. All the errors were somebody in the portion that done by this other guy. Can I get a bonus point? No, you can't. No, everybody receives the same mark. Now, it can make sense, okay? It can make sense to assign ownership of individual portions to individual people. It may work. I'm not saying not to do that. But everybody has to agree on key elements, okay? So everybody has to agree on the expected returns. Everybody has to agree on the final portfolio advice that you give to the two clients, okay? So you cannot, don't let your final mark be a function of something that somebody has done and you have no input at all, okay? Don't come and complain, I didn't agree on the expected return on, whatever. Everybody has to agree on the key elements, okay? Now, to do that, you need to respect some deadlines, okay? Now, there are time dependencies. You cannot build the efficient portfolios if you don't have the expected returns, and you cannot give the portfolio advice to the client if you don't have the model portfolios, okay? So there is a time dependency between part 1, part 2, and part 3. So in order to do a proper assignment, you need to agree on a timeline. This is an idea. This is just a suggestion, okay? That, by August 30, you should be done with the expected returns. By September 13, you should be done with the efficient frontier, okay, etc., etc. I will not enforce this. This is just an example, but this is just to give you more or less an idea of where your group should be, okay? If you arrive as is September 20 and you still don't have the expected returns, I think you are in trouble, okay? Just saying. Okay, so that's the idea of the assignment. Any question on the assignment? Okay, I repeat, I wanted to give you the assignment since now so you can start working on the group formation, etc. I suggest you don't start working on the numbers until next week after we see the MATLAB part related to today's topic. Okay? Okay, last chance to ask questions. Okay, if there are no questions, I'll see you next week. I repeat, next week topic will simply be, we take these methodologies and we apply them with MATLAB, okay? That is technically not necessary. As you see, we can apply them in Excel easily enough, but if we do it in MATLAB, we get a little bit more flexibility to do more things. Okay, thank you very much. I'll see you next week. Taka, you're being a bit racist, and by the way, in Italy, we don't eat meatballs with spaghetti. It doesn't happen. Never happen. Okay? It's not an Italian thing. It's an American thing. Okay? So please.